Hi everyone, I'm Jerzy Eisenberg-Guyot. I'm an assistant professor at Epi, and I've had the pleasure of working with Jerzy for probably about a year and a half or so. And Jerzy comes to us from Tufts University, where he got his both bachelor's and PhD, and then spent a couple years at the local health department in Long Island. And I'm really excited about this work. This is some stuff we've been working on together for about a year, and I'm hoping to get to hear from you all to see what you think. So Jerzy's going to talk to us about Fringe Banks.
So first I'll just give an outline of the talk. So I'll start out with just a brief history of the fringe banking industry, talk about who uses fringe services and why. Then I'll go through methods, results, and discussion, including a discussion of a lot of the sensitivity analyses we did to deal with some of the limitations of our data. Then I'll talk about some policy implications of our results for financial regulations and social welfare programs. And then I'll take questions. And if you have any questions during the talk, just shout out my name and I'll try to answer. So first, a history of the fringe banking industry. So fringe banking, the fringe banking industry includes payday lenders who give customers short-term loans pending their next paychecks, pawnbrokers who buy customers' property and allow them to repurchase it later at a higher cost, car title lenders who hold customers as car titles as collateral for short-term loans, and check cashers who cash checks for a per-check fee. So fringe lenders charge annual percentage interest rates of 400 to 600%. And credit checks for the services are not generally required. Though they're marketed as one-time emergency loans, borrowers frequently borrow repeatedly and they often can't discharge the debts quickly. So the average payday loan borrower is indebted for 5 months and pays $520 for interest of loans of just $375. 1 in 5 car title borrowers has their vehicle seized after default. So deregulation really laid the groundwork for the fringe banking industry. In the 1970s, federal monetary policy to control inflation increased long-term commercial interest rates, and that made the high cost of funds made operating within existing state interest rate caps difficult for banks and other lenders. And in response to political pressure from banks, many states altered their caps or granted exemptions for certain lenders. In 1978, a Supreme Court decision allowed federally chartered banks to charge their home state interest rates to customers in other states. Subsequently, state chartered banks lobbied for the same export rights, and states weakened rate caps to attract business, or kind of led to this race to the bottom between states trying to attract business. Other regulatory changes around this time allowed banks to diversify their investment activities, so you may have heard of the repeal of the Glass-Steagall Act. And they also were able to more easily expand across state lines. This contributed to consolidation in the financial sector. So throughout much of the 20th century, the banking and credit needs of the working poor had been met by local, commonly owned institutions like credit unions and savings and loans associations. But as local institutions merge with larger national banks that reduce less profitable services like small dollar loans that may be more catered to the needs of local communities, and banks' heightened need for revenue due to competition between banks increased the fees on deposit accounts that rendered them prohibitive for many low-income people. So the fringe banking industry has grown precipitously over the last 30 to 40 years. So the payday lending industry, which began in the early 1990s, extended $10 billion in credit in 2001 and $48 billion in credit in 2011. The check cashing industry was nearly non-existent before the mid-1970s. It had almost $60 billion in transactions in 2010. Similar growth has occurred in the pawnbroker and car title lending industries, as well as other forms of consumer lending, and also like more mainstream forms of lending like credit cards, student loans, and mortgages. So due in part to the regulatory changes in the 70s, as well as cheap credit made available to primarily white men through programs like the GI Bill, throughout the latter half of the 20th century, household debt increased substantially. So this graph shows a tripling of household debt to income and household debt to assets ratios from 1950 to 2010. And alongside deregulation were cuts in social services, rising costs of necessities in certain cases, stagnant wages, and concomitant declines in personal savings rates. So this graph shows an approximately threefold decrease in the average personal savings rate among Americans from 1980 to 2017, with a spike after the recession. So inequities in fringe borrowing. So I'll just go over some quick descriptive statistics about who uses fringe loans. So about 8% of the overall population has used fringe loans in the past year, but as you might expect, fringe borrowing is more common among those with lower volatile incomes. And mirroring patterns in wealth inequity, past year fringe borrowing is 2 to 3 times more common among minoritized racial and ethnic groups than among whites. It's more common among those with less education, the disabled, female-headed households, and the unbanked, which are people who lack access to a household bank account. So as I mentioned, and probably unsurprisingly, inequities in fringe borrowing by race ethnicity track inequities in wealth by race ethnicity. So this graph shows how absolute and relative gaps in wealth by race ethnicity have increased substantially over the last 6 decades, despite the graph starting right after the end of formal Jim Crow segregation. And though the causes of the wealth inequities are due to an array of factors beyond the scope of this talk, inequities can be in part attributed to the inequitable access to credit that's been available to many middle-class whites throughout the United States' history. So discriminatory practices in credit markets have contributed to inequities in wealth and in turn fringe borrowing. So some well-known discriminatory practices include redlining, which was a practice initiated by the Federal Housing Administration in 1934 that involved marking maps with red lines to delineate neighborhoods where federally insured and regulated mortgages would be denied to marginalized and racialized groups. And the picture on the right shows a map of redlining in Seattle. It's a little bit washed out, but you can see the Central District, which is an historically black neighborhood, was one of the primary redlined areas. And then mortgage lenders also often require divorced, singled, or widowed women to secure mortgages with a man's signature. And though reverse redlining was made illegal in the 1960s, today under reverse redlining, accessible loans for marginalized groups are often high cost and risky. For example, African Americans were more likely to be steered into subprime mortgages than whites with similar, even much lower credit scores or incomes. And people of color, particularly women, were disproportionately dispossessed of wealth during the subprime mortgage crisis. So regarding fringe banks, they frequently locate in poor non-white communities where people lack access to more mainstream forms of credit. And in our data, we can see that conditional on a variety of demographic and socioeconomic variables, minoritized groups are more likely than whites to use fringe services since they lack access to safer forms of credit. So people primarily use fringe loans to pay for basic living expenses like rent or to make up for lost income from missed work. They're also sometimes used to cover unexpected expenses like medical bills, and sometimes also stuff like house repairs, car repairs, etc. So the unbanked, as I mentioned before, are those who lack access to a household checking account or a savings account. And about 7% of US households are unbanked, and they're about twice as likely to use fringe loans, 5 times as likely to use transactional fringe services like check cashing and bill paying services than those who are banked. So most households go unbanked because they lack sufficient money for an account. They want privacy and distrust banks, or they cannot afford the fees associated with bank accounts. So overdraft fees were pretty rare before deregulation in the 1970s, but they generated $33 billion for banks in 2015, which often sequence withdrawals from largest to smallest to maximize overdraft fees. So that means basically if you have $100 in your account, and 3 withdrawals, one that's $200, one that's $10, and another that's $10. The bank could withdraw the $200 first to trigger an overdraft, then withdraw the 2 smaller withdrawals after that to trigger 2 more overdrafts. Whereas if they had withdrawn the first smaller one first, it would have only triggered 1 overdraft fee with that large one at the end. So construed as loans to the account holder, the typical overdraft fee would be the equivalent of 17,000% annual percentage interest rate, which is much larger than a fringe loan. The material costs of being unbanked are also high, however. So the average household of 4 earning $25,000 per year spends roughly $2,500 on check cashing, bill paying, and money orders. So now I'll just connect fringe banking and unbanked to health, so the motivation for our analysis. So clearly, fringe loan use can exacerbate the well-documented effects of financial hardship on health. Using fringe loans for recurring expenses can lead to spiraling debt and bankruptcy. And there's some evidence that the true costs of fringe borrowing are hidden by lenders, underestimated by borrowers, or that lenders target consumers in a more predatory fashion, like has been documented in the subprime mortgage industry. Nonetheless, the poor often lack other options, and fringe loans can be cheaper than overdraft fees or delaying payments for necessities. So the material consequences of fringe borrowing have to be balanced against the consequences of alternatives, like foregoing necessities or defaulting on other high-cost loans. And as many of you probably know, the stress of debt can harm mental and physical health. So indebtedness is often shamed. Fringe debt may be especially stigmatized. Social isolation, looming default, harassment from debt collectors can contribute to anxiety, depression, and suicide. This has been written about a lot in regards to the recent subprime mortgage crisis. Meanwhile, being unbanked in a largely non-cash economy generates its own sources of stress. So bills must be paid in person at certain locations within certain hours, irrespective of transportation costs, wait times, or conflicting obligations. So chronic stress can put individuals at risk for metabolic and cardiovascular diseases by dysregulating the systems that respond to stress, like the hypothalamic pituitary adrenal axis and the immune and inflammatory systems. And inequities in the distribution of stress and invulnerability to stress across demographic groups may exacerbate health inequities. And fringe borrowers frequently face other chronic stressors like discrimination that might amplify the health effects of financial strain. Once again, however, the net stress from fringe debt or being unbanked needs to be balanced against the stress of alternatives. So our basic research question was, what is the association between fringe borrowing, unbanked status, and self-rated health, which is the outcome we had access to. And note that we're not investigating and don't really have information about how fringe borrowing affects other aspects of household well-being. So it could be that while the material consequences of or stress effects of fringe borrowing are harmful for the borrower, they're good for other aspects of household well-being, like the family member that gets medical care because the borrower took out a fringe loan to pay for it. So we're just focused on the borrower themselves. So why is this work important? So though many studies have assessed the relationship between wealth, debt, and health, rarely do studies distinguish between certain types of debt. So certain types of debt can be used to build wealth, like regulated mortgages, while other sources of debt can drain wealth, like payday loans, for example. And though clearly thinking about structural inequities is essential, it's also important to think about how these structural inequities are reproduced through lower level systems like the credit market and embodied in social outcomes like poor health. And then this builds on recent work in other fields like sociology that documents that pecuniary penalties faced by those living in poor neighborhoods called poverty taxes. So these include monetary sanctions for those living in heavily policed communities, as well as fines and tickets, et cetera, that can reproduce poverty across generations. And then finally, there are policy implications of this work, both in the short term, since fringe breaking can be addressed through smaller welfare programs and changes to financial institutions, as well as through larger structural changes to programs and the economy. So now I'll go over methods for our primary analysis. So data came from the Census Bureau's current population survey, which is a Census Bureau survey conducted to collect workforce data on employment, for example. So we created a person-level ID to merge the June FDIC supplements in 2011, 2013, and 2015 that focus on finances with the following Marches, 2012, 2014, and 2016 ASIC supplements that focus on health. So 9 months separate our exposure and our outcome. And as you can see, our exposure and outcome in our primary analyses were only measured once, which is clearly problematic. We try to address that in sensitivity analyses later. So we use a data set of non-proxy respondents who are household financial decision makers. We did this both to avoid misclassification of the exposure and the outcome by proxy response, and because we thought the material and stress effects of the exposure might be most pronounced among those who bore household financial decision-making responsibilities. So we had about 15,000 people in each of our data sets. The sample sizes differ a little bit just because the questions had different universes for unbanked versus fringe borrowing. So this picture shows the various sampling rotations in the current population survey. I know it's not very intelligible, but basically households in the CPS are sampled 8 times total for 2 4-month periods separated by an 8-month break. Our analysis focused on the rotation group C that's highlighted in red. And they're surveyed in both the FDIC supplement in June and the ASIC supplement 9 months later in March. So they're the only rotation group that's sampled in both of those surveys. And not many people in the health field know that you can follow people longitudinally in the current population survey, or at least not many people do it, and that might be because it's kind of a nightmare to merge across supplements. but it's frequently done in the economics literature because stuff like income is asked in every survey, so theoretically you could get information about someone's income for 8 waves of the survey. So our exposures were past year household, pawnshop, payday, or car title loan use, and unbanked was defined as living in a household without a bank account. So clearly the fringe loan exposure is pretty crude. We don't know how often people are taking out loans, for how much, et cetera. Our outcome was dichotomized self-rated health asked using the standard question, which is shown to be independently predictive of morbidity and mortality, conditional on other health conditions and SES factors. However, it's still a pretty crude measure of health and has less predictive ability among certain demographic groups like Spanish speakers, though dichotomizing it can improve reliability, which is why we did that. So here are the confounders we used, and I won't go through all of them, but one important thing we were missing is information about household wealth or other sources of household debt. So we don't know if people are carrying others like credit card debt, for example. However, we're hopeful that the information on use of other fringe services that we were able to adjust for, so household check cashing use, rent-to-own use, refund anticipation loan use, may serve as proxies for the unmeasured confounders. For unbanked, we adjusted for the same variables except for fringe service use, which we hypothesized were mediators of the unbanked health relationship rather than confounders. So something to think about during the analysis. Yeah?
Take into account like medical bankruptcy?
No, so we didn't have any information about that. We try to address that in a sensitivity analysis later. I'll explain a little bit more. That's definitely a good point. So something to think about, and I just added this slide, so I don't have like a great answer for it yet. But what's the correct counterfactual contrast in the fringe borrowing analysis in particular? For example, is it people who took out a loan compared with people who didn't because they lived in a state where fringe lending was illegal, they had access to low-cost credit and banking services, they got help from family and friends, they weren't duped into taking out a loan by a predatory lender, they didn't take out a loan because they didn't need to. And would we expect the measure of association to be the same if we use each of these groups as our comparison group? So we use a propensity score matching approach for our analyses, and our primary rationale for using a propensity score matching approach is that we're concerned about structural differences between the exposed and the unexposed. Since fringe borrowers and the unbanked tend to be really low SES, it may just be totally different demographically from people who don't use fringe loans. So an overly dramatic example of this is shown in the figure. When there's no region of common support between exposure groups, there's no possibility of causal inference, there's no exchangeability in covariates across exposure groups. So in traditional methods, this problem may be hidden. Propensity score estimation can make the problem clear, the possibility of off-support inference. And propensity score matching with a tight caliper makes off-support inference almost impossible. And I'll explain more about what propensity score estimation is and what propensity score matching is later. In addition, identifying the health effects of fringe borrowing or being unbanked on fringe borrowers or the unbanked, which is the average treatment effect on the treated, was more relevant than identifying the health effects of fringe borrowing or being unbanked on all participants, so the average treatment effect, some of whom were really high SES and had a low probability of ever being exposed. So propensity score matching estimates the average treatment effect on the treated, which I'll explain more later. So here's a brief overview of propensity scores, and apologies for those of you for whom this is a review. So the propensity score is the estimated probability of exposure predicted from observed confounders. Typically, the propensity score is estimated from a logistic model, but it could be estimated from a probit model or other sorts of models. It's basically just an alternative approach to traditional methods that combines multiple covariates into one variable, the propensity score. To calculate the exposure outcome association, one can match respondents on the propensity score, which is what we did, adjust for the propensity score, weight observations by the inverse of the propensity score, et cetera. So we use nearest neighbor propensity score matching in our analysis. So each exposed participant was matched to, in nearest neighbor matching, each exposed participant is matched to n unexposed participants who have the nearest or the most similar propensity score. A one-to-one matching procedure is shown in the figure below. Propensity score matching attempts to make the exposure independent of measured confounders, and frequently you specify a maximum distance within which the exposed can be matched to the unexposed, so that's called the caliper. And due to the matching procedure, so I mentioned this before, which matches unexposed respondents to exposed respondents on the propensity score and discards people who are unmatched, propensity score match analyses estimate the average treatment effect on the treated rather than the average treatment effect like in a normal regression model, assuming no unmeasured confounding. So our propensity score matching approach was based on recommendations and a sort of how-to paper by Elizabeth Stewart that came out a couple years ago. So first, each participant's propensity score was estimated using logistic models that included the aforementioned confounders plus squared age and income terms. Then we performed nearest neighbor matching without replacement to match a maximum of 2 unexposed participants to 1 exposed participant on the propensity score within 0.05 standard deviations of the propensity score, so the caliper. Then we estimated prevalence ratios for the exposure outcome association using Poisson models. And I call these prevalence ratios because, again, our outcome was only measured once, so this might have been prevalent poor fair health rather than incident poor fair health. So we adjusted for variables in the propensity score match models to address residual covariate imbalance that we thought might remain after matching, and because we thought certain variables were strong confounders, and we wanted to make sure those were adjusted for in our analysis. We didn't adjust for all the confounders due to problems with model convergence. Originally, we had used a sample that had clustering by household, and our GE models particularly weren't converging. Then we were also concerned about positivity. And then finally, we bootstrapped the matching and regression 1,000 times to correctly estimate the variance. And I'll explain what I mean by that. So we bootstrapped for 2 primary reasons. First, the propensity score is estimated from a model rather than being a measured variable. This point seems a little bit controversial and maybe less important, since it seems like some evidence suggests that not taking into account the fact that the propensity score is estimated results in an overestimate of the standard error, so it's anti-conservative. And second, and more importantly, the order that exposed participants are chosen and matched to unexposed participants can impact which participants are chosen for the analysis. And this is particularly problematic when doing K-to-1 matching without replacement, which is what we did. So our bootstrap procedure proceeded in several steps. First, we drew a random sample with replacement from the data that was the size of our original data set. We performed the propensity score matching procedure, estimated the Poisson models I described on the previous page, repeated steps 1 to 3 1,000 times, and then calculate confidence intervals based on the sampling distribution of the prevalence ratio. And this procedure took a really long time. It took like 8 hours for each of our data sets, which was kind of frustrating. And ended up just making the whole analysis take way longer than it would have otherwise. So it's a downside to doing this. So this just shows what I meant by saying that the order of matching matters. So for example, if we're doing 2-to-1 matching without replacement with a caliper of within a caliper of 0.2 propensity score units, and we start matching with the exposed participant that's first in the top row. They'd match to 2 unexposed participants. Then we move to this person that's second in the top row. They'd match to 2 unexposed participants. However, if we start with the second exposed participant, as shown in the second scenario, they'd match to 2 unexposed participants, one of whom is different from whom they matched to before. And then if we match that first exposed participant, they'd only match to 1 unexposed participant. And if the outcomes differ for the chosen matched pairs, then the prevalence ratio estimate will differ. So not taking this into account would underestimate the variance. So something else to think about, I also just added this slide. So in addition to the historical and social context we provide for analyses, how could we have more explicitly analyzed whether the health consequences of these exposures disproportionately burden certain demographic groups? And I have something in mind, something that we talk about in Epi 512, and I'm wondering if others have thoughts. And part of the reason why we didn't do this is because we already have so much going on in the paper. We didn't really have space for more analyses. But I think it would have been important to incorporate analyses of inequity empirically into our study rather than just providing context for it. So we did a variety of sensitivity analyses. First, we were concerned about unmeasured confounding. So we were concerned about unmeasured confounding by factors like wealth, other sources of debt, baseline health status. So we ran propensity score match analyses with check cashing use and refund anticipation loan use as control exposures. So these are used by similar populations to those who use fringe loans but are non-debt creating. They're just transactional. So we hypothesized they'd be less harmful for health. If unmeasured confounding were minimal, we expected these exposures to have smaller or even no health effects relative to fringe borrowing. We were also concerned about reverse causation because, again, our exposure and outcome were only measured once in the analyses. This is a concern because fringe loans are sometimes used to pay for medical debt or cover fallout from illness, like missed work. And similarly, people may become unbanked due to the financial consequences of illness. So if you recall from earlier on in the presentation, this is the sampling structure of the current population survey. And rotation group C, shown in red, which is the rotation group we focused on in this analysis, actually was also sampled in the ASIC 3 months prior to baseline and asked about their health status. So we didn't know this when we originally started the analyses, and Anjum did a presentation at CSDE back in June, and someone brought this up, that it would be possible to merge in that prior ASIC supplement into our main data set. So we merged the ASIC supplement 3 months prior to baseline with our main sample and excluded those reporting poor or fair health, income from disability benefits, or being uninsured on the March ASIC 3 months prior to baseline. And then we estimated prevalence ratios via Poisson models on non-propensity score match samples since the exclusions and then conditioning on another wave of the survey chopped our sample size by about half. And if reverse causation were minimal, we expected these exclusions to have small effects on the prevalence ratio estimates. Note that the temporal relationship between fringe borrowing and the exclusions is still ambiguous, since our fringe borrowing exposure was past year fringe borrowing, yet we're excluding people who report poor fair health, income from disability benefits, or being uninsured 3 months prior to baseline. So there's still a little bit of ambiguity there. So our final sensitivity analysis was an instrumental variable analysis conducted on the for the fringe borrowing analysis. So some econometric terminology and motivation for the instrumental variable analyses. So if the exposure outcome relationship is confounded, or the outcome causes the exposure, which are problems I described earlier, the exposure is endogenous and ordinary methods will be biased. So given endogeneity, we can estimate unbiased effects with an instrumental variable, which is a variable that predicts exposure but has no direct effect on the outcome and no prior causes in common with the outcome. So an example of this would be treatment assignment in a randomized control trial, since clearly that's a cause of the exposure, and if randomization is done correctly, it shouldn't have any prior causes in common with the outcome and no direct effect on the outcome aside from through its effect on the exposure. So the top picture is a DAG of a valid instrument, since the instrument Z affects the exposure X, but has no direct effect on the outcome Y, and there are no unmeasured confounders of the instrument outcome relationship. The bottom picture, meanwhile, shows an invalid instrument, since there's an unmeasured confounder of the instrument outcome relationship. So we conducted two-stage least squares instrumental variable analyses, which are one of the more common types of instrumental variable analysis. So the two SLS analysis is two primary steps, a first stage model and a second stage model. In the first stage, fringe borrowing was regressed on the instrument and the aforementioned confounders in an OLS model. And then the second stage, self-rated health, was regressed on predicted values of fringe borrowing generated from the first stage model along with covariates to calculate prevalence differences rather than prevalence ratios. So 2SLS provides an estimate of the local average treatment effect, which in this case is the health effective, or the effect of fringe borrowing on self-rated health for those whose borrowing behavior was affected by the instrument, in this case regulations, which I'll explain. So this is this group is also called the group of compliers. This is a small portion of the population. We can't identify exactly who these people are, which is a drawback of instrumental variable analyses. So our instruments were state-level regulations of payday, pawn, and check cashing outlets. The prior research shows that these regulations are associated with reductions in fringe borrowing, since fringe lending becomes unprofitable after the regulations are put in place. So states were considered to have payday loan regulations if they capped the annual percentage interest rates at less than or equal to 36%. They're considered to have pawn regulations, moderate pawn regulations if they cap the interest rate below 120%, and strong regulations if they cap the interest rate at less than 36%. Then states were considered to have check cashing regulations if they had any cap on fees at check cashing outlets. And these instruments would be invalid if fringe banking regulations are associated with unmeasured factors that influence self-rated health. For example, progressive state-level policies. If we didn't adjust for those in the analysis and they're associated with fringe lending regulations, then clearly that's an unmeasured confounder of the instrument outcome relationship. So since having a single strong instrument is preferable to having multiple weak instruments, both in terms of bias and precision, at least from what I can tell. We combine the three instruments into a single weighted instrumental variable normalized to the range 0, 1, and it had 12 possible values. So to do this, we use a method by some folks at Stanford. Sanjay Basu just came out with a paper where he did this. So first, we regressed fringe borrowing on each regulation in logistic models. So we had fringe borrowing as the outcome and the regulation as the exposure. We record the deviance for each instrument from the logistic models, which is just a proxy for the discriminatory power of the instrument, so how strongly associated the regulation was with fringe borrowing. Then we created a single weighted instrument, which was an average of the individual instruments weighted by their partial deviances. And exactly how we did this isn't so important, but basically the instrument ranged from 0, which meant that the state had no regulations, all the way to 1, which meant a state had the strictest regulations. And you can see the deviance numbers aren't really interpretable either, aside from in relation to each other. So you can see the pawn regulations were most strongly associated with reductions in fringe borrowing. Payday regulations were associated with moderate reductions in fringe borrowing, and check cashing had the least strong effect on fringe borrowing. So this is the final slide about instrumental variable analyses. So we implemented the two-stage least squares model on propensity score match samples to increase instrument strength, since we hypothesized that fringe borrowing regulations would be unlikely to affect the borrowing behavior of high SES participants who would be unlikely to take out a fringe loan regardless of the regulatory environment. And for the same reason that I described before, we bootstrapped estimates of our coefficients and standard errors. So there are several assumptions of instrumental variable analyses that need to be verified, and if any are violated, bias tends to be in the direction of the ordinary least squares estimate, which is obviously problematic. So the first assumption is that the instrument is associated with the exposure, which we tested by calculating robust F statistics for the significance of the weighted instrument in that first stage regression that I described before, and we did that for each of the 1,000 bootstrap repetitions. The second assumption, which isn't empirically verifiable like the first assumption, is that the instrument is independent of the outcome, conditional on exposure and covariates. So first, we tested this by calculating descriptives for the sample stratified by quartiles of the instrument. So basically, we hypothesized that if measured confounders were unevenly distributed across levels of the instrument, it might be true that unmeasured confounders are also unevenly distributed across levels of the instrument, which would render the instrument invalid, since there'd be unmeasured confounders of the instrument outcome relationship. We also conducted a variety of sensitivity analyses for the instrumental variable analysis to test the robustness of our results to alternative modeling specifications, and I'll describe the results in a few slides. The final assumption of IV analyses is not testable. The final assumption is monotonicity. This would be violated if, unlike most respondents, some respondents took out loans in states with regulations and refused to take out loans in states without regulations. We believe this is unlikely, since the regulations that we studied are essentially bans on fringe loans, so there wouldn't be any fringe loans available even if someone wanted to take out a loan once the regulation was put in place. All right, so our results. So these are just kind of crude descriptives of the prevalence of poor fair health in our study. So about 13% of our total sample reported poor fair health, 23% of fringe borrowers reported poor fair health, and 31% of those who were unbanked reported poor fair health, and those are shown in purple. So here's the density plots of propensity scores on the log scale across the exposed and the unexposed. You can see there's actually pretty good overlap in the propensity scores across the exposed and the unexposed. So our concerns about structural differences and covariates between exposure groups wasn't really supported by the data. So here are the median standardized mean differences and confounder means and proportions between exposure groups across the bootstrap samples before propensity score matching in gold and then after propensity score matching in purple. So standardized mean differences are just a way to compare the means and proportions of variables between exposed and unexposed groups. And they're frequently used for propensity score matching. Standardized mean differences of less than 0.1 are generally considered to indicate negligible imbalance in covariates across exposure groups, though that's just kind of a general guide. And we can see that after matching all standardized mean differences aside from rent-to-own use in the fringe borrowing analysis had standardized mean differences of less than 0.1, indicating that the propensity score matching procedure succeeded in making exposed and unexposed groups exchangeable on observed confounders. So here are the results from the main analysis and some sensitivity analyses focused on fringe loan use. So fringe borrowing was associated with a 38% higher prevalence of poor fair health with a 95% confidence interval of about 1.14 to 1.68. Excluding those with prior poor fair health, disability income, or being uninsured on the March ASIC 3 months prior to baseline didn't really change the prevalence ratio estimates. Nonetheless, the precision was considerably worse for the analysis that excluded those with poor fair health. This is because, at least I think, there are few respondents who switch from good health 3 months prior to baseline to bad health or to poor or fair health 9 months after baseline. So those respondents would have to switch from poor fair health to good health. No, getting confused. Yeah, respondents would have to switch from good health to poor health over the course of just 1 year. So there are few respondents with the outcome of interest in that model. And then you can see the results for the control exposures at the bottom, and both check cashing use and refund anticipation loan use had small, null health effects. Thus we think that both unmeasured confounding and reverse causation didn't have necessarily undue influence on our results, at least based on these sensitivity analyses. Here are results from the unbanked analysis. So in the main unbanked analysis, unbanked status was associated with a 17% higher prevalence of poor fair health with a 95% confidence interval of 0.99 to 1.39. It's clearly a much smaller health effect than we observed for fringe borrowing. And as with fringe borrowing, the exclusions had little effect on the estimates, though excluding those reporting poor fair health prior to baseline increased the prevalence ratio estimate to 1.4. But clearly you can see the precision was really poor with the confidence interval overlapping the confidence interval for our main analysis basically totally. And now I'll go over the instrumental variable results. So this is a map of the distribution of values of the weighted instrument by state, with darker colors indicating stronger fringe lending regulations. And you can see there's a potentially problematic clustering of stronger regulations in the Northeast. This is potentially problematic since people living in the Northeast tend to report better health than people living in other states. There are also progressive state-level policies in the Northeast that don't necessarily exist in states like the South. So the instrument may be correlated with unmeasured factors that influence health. So the first diagnostics for the strength of the IV, the estimated coefficient across the bootstrap samples from the first stage regression was negative 0.16, which corresponded to a 40% reduction in the probability of fringe borrowing in states with the strictest regulations relative to states with the weakest regulations. And the median F statistic for the significance of the weighted instrument in the first stage regression across the bootstrap samples was 20.6. And F statistics greater than 10 are generally considered to indicate sufficient instrument strength, though again, this isn't a hard rule. So I think based on this information, the instrument was sufficiently correlated with the exposure to continue with the instrumental variable analysis. Here are the standardized mean differences for the confounders across quartiles of the instrument. And you can see that most of the standardized mean differences in the confounders across levels of the instrument are less than 0.1. But there are larger differences in metro area, race, ethnicity, and US born, indicating that the instrument might be somewhat correlated with measured and potentially unmeasured confounders. This means instrumental variable analysis should be interpreted cautiously since the instrument outcome relationship may be confounded. Still, even the largest standardized mean differences are pretty small, so the largest ones are about 0.2. So it's a little bit, there isn't clear evidence either way, I would say. So here are the prevalence differences estimated from the two SLS analyses. So remember, these are prevalence differences, not prevalence ratios. The main two SLS analysis, the absolute difference in prevalence of poor fair health for fringe loan users versus non-fringe loan users was 33%, with fringe loan users having the higher prevalence of poor fair health. You can see across these analyses, precision was really poor, which is often a problem in two SLS analyses since the exposure is estimated from a model rather than measured. It's always going to be worse than what you have in an OLS model or an ordinary regression. So our first sensitivity analysis was run to test if correlation between unmeasured factors in any one instrument was biasing the results. So dropping payday, pawn, or check cashing regulations from our weighted instrument didn't substantially change the prevalence difference estimates, though clearly the precision was worse, particularly when we dropped pawn regulations, since that was our strongest instrument, and the dropping those individual instruments made our weighted instrument weaker than it was in our primary analysis. Next, we tested if correlation between unmeasured factors within the instrument with any one region was biasing our results. So we reran the analyses, dropping one census region at a time from our analyses. And as with the prior sensitivity analyses, this didn't change the prevalence difference estimates, though it really blew up the precision, particularly dropping the Northeast from the analysis, where the prevalence difference estimate still may be 0.3, but the confidence interval is like -0.7 to over 1, which doesn't make any sense because prevalence differences are bounded between -1 and 1. And I think this happened partially because it just decreased our sample size a ton, and then also most of the states with the strictest fringe lending regulations were clustered in the Northeast, so there was no one left with an instrument value of 1, or very few states left with an instrument value of 1 after we did that. And then finally, we adjusted for year-specific state-level policies that may be associated with the instrument and with health. So indicators of state-level Medicaid expansion, the existence of a state-level earned income tax credit program, and the proportion of eligible state residents participating in the Supplemental Nutritional Assistance Program. Once again, this didn't change the prevalence difference estimates, though precision worsened, particularly when we adjusted for the state-level EITC programs. And just one note, these are pretty huge prevalence difference estimates. So converting the prevalence ratio estimates from our primary propensity score match analyses to prevalence differences using average adjusted predictions at the means demonstrates that the 2LS estimates are 5 or 6 times larger than the propensity score matched estimates. Nonetheless, 2SLS calculates local average treatment effects rather than average treatment effects among the treated, so the results aren't directly comparable necessarily. So we believe that these results, coupled with our main analyses, support our primary findings, but the actual effect sizes here aren't of primary interest, given that they're only relevant for a small portion of the population, those whose fringe borrowing behavior was affected by the regulations. And then once again, they should be interpreted cautiously because of the potential correlation between unmeasured factors in our instrument. So now I'll go through the discussion. So in summary, we found that fringe borrowing and unbanked status were associated with worse self-rated health, and sensitivity analyses generally supported these findings despite the major limitations with our data. The fringe borrowing health effect was significantly larger than the unbanked health effect. So strengths of the analysis include the fact that this is, to our knowledge, the first empirical analysis of the exposures in the health literature. Few public health studies have leveraged the CPS's panel structure and followed people over time. And then the findings were supported by our sensitivity analyses, which I already mentioned. However, there are a number of limitations to our analyses. First, our outcome was self-rated health, which is, although predictive of morbidity and mortality in certain groups, is less so in certain low SES groups, which are the primary people exposed in our analysis, so that's obviously problematic. Then I've mentioned throughout the presentation just the limitations of our data, the limited exposure, outcome, and covariate data we had. One limitation I haven't talked as much about is that we only had information about any past year fringe borrowing, not information about fringe borrowing frequency or amounts, so we couldn't really analyze dose effects, which I think would have been interesting and important. So now I'll go over some policy implications. And there are a number of ways in which the social, economic, and health effects of these exposures might be addressed. So one option is financial regulations, which we think are unlikely to sufficiently address the both economic and health consequences of the exposures. So many states have set APR and fee caps on fringe loans, typically a cap of 36%, which I discussed before. And this is the amount recommended by consumer groups. And some states have reported positive regulatory effects after implementing such regulations. Nonetheless, lenders can often skirt regulations by disguising their services and moving online. And as discussed previously, the needs of low-income folks may be unmet or satisfied at greater cost if they just suddenly lose access to fringe loans. Some analysts, meanwhile, have argued for regulations that enable mainstream banks to re-enter the small dollar loan market. Since recent legislation has effectively legislated away the ability of mainstream banks to offer small dollar loans. However, lending to the poor and banking the poor isn't particularly profitable. Low-income folks often hold small deposits. They frequently default on loans. And given that banks really only care about their bottom line, it's unclear that they'd want to re-enter the small dollar loan market in sufficient numbers to reduce the need for fringe borrowing. Moreover, recent scandals regarding discriminatory lending, fraudulent accounts like at Wells Fargo, And overdraft fees mandate caution about the role of mainstream banks in low-income lending. So it's really hard to see mainstream banks as like the solution or necessarily the good guys in this conversation. So another option is building alternative financial institutions. And to date, most government initiatives to bank the poor, like the CDBA and the CRA, have tried to enlist private, profit-motivated banks to bank and lend to the poor, and have thus been largely ineffective since it's not really a profitable endeavor. So loans made through the CRA are often subprime, since one of the only ways to make money off of low-income folks is by charging them really high interest rates, and banks created through the CDBA have struggled to survive due to limited government support. So successful initiatives should be built outside the mainstream banking sector, like credit unions and savings and loans associations were in the past. Options include the creation of a postal banking system, which actually existed in the US from 1910 to 1963 and has analogs in other countries. So postal banking would address the geographic barriers to banks, given the ubiquity of post offices in low-income communities, and the cost barriers to banks, given the cost barriers of low-income lending, given a nonprofit mission. Municipal banks, community-led lending circles could serve similar functions. However, with half of Americans reporting they'd be unable to produce $400 cash for an emergency, and the common use of fringe loans to pay for necessities, clearly the core of the fringe banking problem stems from financial instability, scarce resources, and the high cost of necessities. So robust public provision of necessities and labor protections would actually address the root causes of fringe service use. There's pretty good data to support this. So a recent study that was published by the Federal Reserve found that each $1 increase in the state level minimum wage was associated with a 40% reduction in the probability of fringe borrowing. Another study that was just published in Health Affairs found that early Medicaid expansion in California was associated with an 11% decrease in fringe loan use. And clearly these programs would have other salutary effects on other social determinants of health and health equity. And then addressing broader structural factors that deepen poverty for marginalized groups, like segregation or mass incarceration, are also clearly important. And that's it.